Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are doing a deep dive into two really powerful forces that are reshaping global investment strategy. And they couldn't be more different. On one side, you have policy. We're looking at how trade tensions are forcing this huge rethink in the electric vehicle market. And on the other, technology.
Exactly. How AI is finally making that leak from the digital cloud into the physical world. It's setting up a whole new kind of arms race in robotics.
And these trends are so critical because they hit the most expensive parts of global business, right? Manufacturing, platform tech.
That's right. So first, we're going to break down this really controversial trade deal the EU just made with China. It's a minimum price strategy.
And we'll get into why that pivot is actually speeding up Chinese investment right into Europe's backyard.
Then we'll shift gears. We'll look at the big moment from CES 2026. The consensus is the debate is over. Robotics is here.
Right. So for investors, the question isn't, can a robot balance on one leg anymore? It's, okay, when and where are they being deployed, and who's controlling the software that makes them actually work? We've dug into the data to find the winners in both of these changing landscapes. Okay, let's start with this EU-China EV situation, because for months, the tension was, it was incredibly high.
Oh, absolutely. The talk was all about a looming trade war.
Yeah, and the EU was threatening these massive punitive tariffs. We're talking close to 50% on major Chinese players like BYD, CAC, Geely. They were citing dumping concerns.
Right, the idea that huge state subsidies were letting them sell cars unfairly cheap.
But then at the last minute, it seems like the EU pulled back from the brink. So what was the mechanism they used instead of a tariff war?
So what came out, according to recent analysis, is something called a minimum import price, an MIP.
An MIP.
And it's a fascinating tool because it completely avoids the political blowback a huge tariff would have caused.
How so?
Well, instead of the EU government collecting a big tax on these cars, which would have triggered immediate retaliation from China on, French cognac or German luxury cars.
The things that really matter to their economy.
Exactly. The two sides basically agreed to a price floor.
Okay, so if I'm a Chinese EV maker, the government is essentially saying, you can sell your car in Europe, but you absolutely cannot sell it for less than, what was the number, about 30,000 euros?
That's what the analysis suggests, yes.
Yeah.
That's the core of it. They have to keep their prices above that line. And that's fundamentally different from a tariff.
Right, because a tariff is a tax the government collects. This isn't a tax.
Not at all. The MIP forces the company to raise its own price. The extra money stays with them in their pockets.
Okay, let me try a simple analogy for you. Imagine you own a coffee shop, and a new, heavily subsidized shop opens across the street selling amazing coffee for just $1.
Right. You can't compete with that.
Exactly. So this MIP policy would be like a regulator telling that new shop, look, you have to sell your cheapest coffee for at least $5. They can still operate, but they can't just undercut everyone purely on a subsidized price.
That's a perfect analogy. It removes the dumping threat without slamming the door shut. And some analysts have even called this a strategic symbiosis.
A symbiosis? How?
Well, Europe gets what it wants. It shields its legacy automakers like VW from that rock-bottom competition. And it keeps affordable EVs flowing in to meet its climate goals.
Okay, but if Europe avoids retaliation and China keeps market access and gets to pocket the extra profit, who loses here? Doesn't this kind of reward China for those state subsidies in the first place?
That is the million-dollar question, isn't it? And from a pure free trade perspective, yes. It looks like a quiet acceptance of those subsidies as long as they don't crash the European market too fast.
And the European consumer pays a little more.
The European consumer pays more, and the biggest financial gain goes directly to the Chinese corporations as a healthier profit margin.
This choice just creates such a massive split across the Atlantic. The sources all point out that Europe's policy of managed openness is the complete opposite of what the U.S. is doing.
It's a night and day difference. While Europe is trying to manage the flow, the U.S., especially under the current administration, has a full-on containment strategy.
100% tariffs, right.
100% tariffs on the cars, and a push for an outright ban on Chinese connected car software and hardware. The U.S. is building a wall. Europe is basically managing a toll booth.
So global car companies now have to plan for two completely different worlds.
Precisely.
And here's where it gets, frankly, a little ironic. The data shows that these very trade barriers, whether it was threat of tariffs or this new MIP, are actually speeding up Chinese investment in Europe.
It's a classic case of regulation fueling localization. If you can't ship the car, you ship the factory.
They're just jumping the fence.
They're jumping the fence. We're seeing it already. BYD is starting production in Hungary. Chery is expanding in Spain.
And once those cars are built there,
They're classified as European-made. They bypass the MIP. They bypass the tariffs. It completely neutralizes the protectionist policy. So you get this ironic outcome of Chinese capital and tech jobs flowing into Europe.
So what does this all mean for the big European legacy brands? Did the MIP actually protect companies like Volkswagen or Stellantis?
It only bought them time, maybe 3 to 5 years max. It is not a long-term shield.
Why not?
Because that price floor forces their Chinese competitors to change their game. They can't be the cheapest anymore, so now they have to be the best tech per euro.
They have to compete on features and quality.
Exactly, which pushes them right into the mid to high-end market. That's the sweet spot where European manufacturers make most of their profit.
So if you're an investor looking at those legacy auto stocks, you have to be careful.
Extremely selective. You can't just assume this price defense works. You have to find the companies that have real, radical cost breakthroughs like Renault's Ampere division or truly superior software. Hiding behind the MIP is a risky bet now.
You mentioned a profit paradox earlier. That sounds, well, counterintuitive. Can you break that down? How does raising prices make them more profitable?
Right, it's a huge insight from the analysis. When the MIP forces them to raise their price, their average selling price, or ASP, that extra money, which would have gone to the EU as a tariff,
Now stays with the company.
stays entirely with the company. So even if their sales volume in Europe flattens for a bit, their operating profit margin, their OPM, could shoot up. They just keep the cash.
So the real structural winners are the companies that set up those local factories like BYD in Hungary.
They get the best of both worlds. They neutralize the trade risk, and they get to sell at a higher mandated price. It's a brilliant move.
And what about the supply chain?
Well, Europe's deep reliance on China for batteries from companies like CATL and Gotion was a huge reason for this compromise. So this MIP deal is actually a good sign for the entire global battery supply chain, as the European market is still open for business.
It's fascinating how a trade policy can force companies to completely rethink where they build things. That old model of one giant factory serving the whole world seems, well, obsolete. Speaking of the physical world, let's pivot to technology. The next big shift is AI moving out of the cloud and into our reality. We're diving into the biggest story from CES 2026, the rise of physical AI.
This was the theme that just dominated everything. Reports from CTA and Reuters all said the same thing. AI is moving beyond screens and search bars.
It's getting hands and feet.
It's integrating into the real world. In robots, in factories, autonomous cars, smart appliances, all of it.
And NVIDIA's CEO, Jensen Huang, he called it the ChatGPT moment for robotics. What does that actually mean in practical terms?
It means we've moved from robotics as a research project, where scientists got excited if a robot could just pick up a block,
Right.
to a full-on platform competition. NVIDIA didn't just show a new chip. They laid out an entire roadmap, chips, models, software to speed up the whole development cycle. They're trying to become the standard operating system for every robot on the planet.
Like what Microsoft did for the PC.
Exactly like that. Or Google for mobile.
Okay, that's the hype. But let's get a reality check here. We've seen analysis from places like AlixPartners saying that large-scale adoption is still a huge hurdle. Cost, safety, just the raw power they consume. Isn't calling this a ChatGPT moment a bit optimistic?
That's a critical point. The bottleneck isn't really raw software power anymore. It's the messy complexity of the real world. The proof that a robot can exist is over. Now, the proof of its economic viability is just beginning.
So the challenges are immense.
Immense. They need tons of power, incredibly expensive sensors to be safe, and collecting enough good data from a chaotic factory floor to make them reliable is a monumental task. It's time to stop watching concept videos and start looking at execution schedules.
And you could feel that tension just walking the floor at CES, right?
Yeah.
Sources like Forbes and Japan Times said that while Boston Dynamics was the symbolic star, Chinese companies just dominated with sheer volume.
You saw two completely different philosophies in action. On one hand, you had, as Forbes called it, the Canton Fair of robotics. Hundreds of Chinese firms with every kind of robot you could imagine. They have the hardware muscle.
And the cost advantage.
For sure. But on the other side, you had a company like Boston Dynamics showing one humanoid moving maybe a bit slower, but with an engineer right there explaining the safety certifications and the specific tasks. The showmanship is gone. It's about liability now.
Which brings us to Boston Dynamics, now owned by Hyundai. Their whole presentation was different this year. It wasn't about cool tricks, it was about a clear deployment plan.
Absolutely. And that gives investors a real metric to watch. Hyundai is planning to phase the Atlas humanoid into its Georgia factory starting in 2028.
Starting in 2028.
And they're focusing on boring, repetitive stuff first, like sorting parts on the assembly line. The goal isn't backflips anymore. It's achieving near-perfect reliability and the ability to learn a new, simple task within 48 hours.
So that shift from cool moves to verifiable reliability, that establishes what you'd call the minimum unit of commercialization. The conversation is finally about deployment and cost, not just the tech demo.
That 2028 date is the first real finish line investors can track for this technology in a mass market setting.
So with all this focus on platforms and deployment, where will the real profit be made? Is it in the companies building the physical hardware, the arms and legs? Or is it somewhere else?
The consensus is fascinating here. The high-value profit pool probably won't be in the hardware itself. It's going to be captured in the stack.
The stack.
The chips, the AI training models, the simulation tools, the operating software, and especially the service layers that maintain reliability. NVIDIA's whole strategy supports this. They want to provide the tools for everyone else.
A bit like how Apple and Google captured most of the profit in the mobile boom, even though hundreds of companies made the actual phones.
That's the perfect parallel.
So where should investors look for the quickest, most measurable ROI in physical AI?
The first winner, clearly, is going to be in factory and logistics applications. It's repetitive, standardized work where the ROI, gains in productivity, quality, safety, can be clearly measured and proven.
And the consumer market. For the home.
Still facing the classic hurdles. The price is too high, there are privacy concerns, and honestly, a lack of a killer app. The fact that we didn't see hyped products like Samsung's Bally this year tells you everything. The smart money is following efficiency gains first.
And what about that sheer volume of hardware from China? Does their cost advantage mean they're poised to dominate robotics globally?
Not so fast. There are major roadblocks. Their path of global expansion is bottlenecked by regulatory compliance, safety certifications, cybersecurity, you name it.
And legal liability if something goes wrong.
A huge one. The next 2 to 5 years won't be a race to build the cheapest robot. It's going to be a reliability competition. It's about which platforms can meet global standards for safe, verifiable operation. The West will prioritize safety over price every time.
Okay, let's wrap this up. We've covered 2 massive shifts today, and they seem connected. First, in trade, the EU chose price controls, pushing Chinese EV makers to go upmarket and invest locally in Europe.
And second, in tech, physical AI is officially here, but the real game is in the software platforms, not just the cool demos. The first real returns will come from factories, where reliability and execution are everything.
So what's the common thread?
The transition in both areas, whether it's trade policy with the MIP or technology with robots in factories, it all points to one powerful trend: deeper localization.
So if the cost of managing these complex global supply chains and trade risks keeps going up,
It raises a big question for the future. Will global commerce look less like these long interconnected chains and more like regional manufacturing ecosystems built around specific regulatory blocks, one for the US, one for Europe, one for Asia, all serving their local customers? Something to think about as you look at your own investments.
an excellent thought to end on. Don't forget to subscribe and hit that like button.